Kind Profits here. In my last video I discussed the S&P 500 index fund that was originally created by Jack Bogle at his company Vanguard. This when it came out and throughout the last few decades has been a rather incredible innovation for investors. Warren Buffett, a billionaire himself, has said that what Jack Bogle did for the average investor was the greatest impact of any other person in his generation. What Jack Bogle did with the S&P 500 index fund is allowed someone to purchase a piece of the top 500 companies listed in the S&P 500, but be able to do it with just normal amounts of money instead of having to spend tens of thousands of dollars to buy an Amazon stock, an Apple stock, a Microsoft stock, a Tesla stock. Instead, you would just buy this one vehicle where you get a small percentage of each of those companies. So for instance, right now, the VOO, which is the Vanguard S&P 500 fund, if you look up that symbol VOO, it costs around $250. So over time, that just keeps going up in value, and it goes up in value at the ratio that the S&P 500 companies in aggregate, their market cap increases. So this is a great way to invest. And the other aspect that allows it to outperform mutual funds and hedge funds is that it's a passively managed fund. What I mean by passively managed fund is that there's much less research going into this. Instead, you're just kind of piggybacking off of the S&P 500. If you use a total market index fund, you're just piggybacking on everything the New York Stock Exchange lists. What an actively managed fund would be a fund where you have someone whose full-time job, or a team of people whose full-time job is just to do research on whatever stocks that they choose to invest in. So usually it's around 30, give or take. It could be up to much higher, but it could be as low as 20 even. But what a mutual fund manager would do is become an expert on these stocks. One way they might do research, for instance, is by looking at suppliers or looking at retail. You can talk to the big sellers of an iPhone, T-Mobile stores. You might be able to get information about how well the iPhone is selling, and then use that information to decide whether or not you think the price of Apple is going to go up. Similarly, you could look at manufacturers. If one company manufactures a screen for the iPhone, and then you find out that they are actually manufacturing less screens than they originally projected, then you can take that to mean that probably the iPhone is not selling as well as people had originally predicted, and then adjust accordingly with the Apple stock. So this is a way that many people invest, but the index funds, like especially the S&P 500, has tended to keep up or outperform actively managed funds. One of the reasons that they've been able to do this is that actively managed funds take out a percentage of any profits, any gains, to pay for all that research, to pay the mutual fund manager, the hedge fund manager. These people can make millions of dollars, and it equates to maybe having a fee of 2% come out every year of your investment. So they should be able to overcome that. If they're a good investor, they might gain 10%, then 2% of that's going to go for their fee, so you end up making 8% a year. Whereas the Vanguard VOO index fund of the S&P 500 has a very small fee of less than 0.1%. By just that fee alone is a reason why people will recommend an index fund or an ETF over actively managed funds, and it's been able to keep up with the funds despite all the extra research they can do. Just having a broad base in the stock market overall tends to be a equally good investment or in the same range. But as I discussed, the S&P 500 does invest in stocks that I don't necessarily agree with, stocks that have ethics problems or are just profiting from things that I don't really want a piece of, building bombs, polluting the environment, that sort of thing. Luckily, there are some alternatives that are passively managed or keep a similar strategy to keep low a low expense ratio. One of those stocks is actually offered by Vanguard. It's the ESG US stock ETF. The symbol of it is ESGV. ESG is a term I'll discuss more in other videos, but it stands for environmental, social, and governance. And it basically is just a term for these companies are trying to comply with a certain set of moral and ethical standards in how they conduct business. So what I'd recommend if you've never heard this term before is maybe look into what ESG is, maybe look at the ESGV ETF. You just enter that stock symbol, just like if you were to look up Apple, you would enter AAPL. Just look up this and you can find information at Yahoo Finance, all the CNBC's website, any of these places will have information about it. And what I'll do in the future videos is actually break down what stocks are included to make sure that nothing's jumping through the cracks. The way these can keep such low rates themselves is because, again, instead of doing the research themselves, a lot of these funds will actually be using a ratings agency that will rate companies on their ESG compliance, meaning their ethical standards, that someone else has done the rating for them. Once the rating's been done, they just choose to include it. And then if the company for some reason falls out of compliance, they would drop it. But the ESG fund that Vanguard offers keeps with Jack Bogle's original standards, only a 0.12% fee, so it is something to consider. It's much easier to do this than trying to buy all those stocks by themselves, which will be very expensive. If you just want to get in at the ground level and start investing today, choosing an ETF that agrees with your ethics and morality is a great choice. So keep that in mind. Look into VOO, the S&P 500, and look into ESGV just to do some background. Again, thanks for watching.